Hundreds of people are dead in Nepal right now. Hundreds more are still missing. And the flood that killed them came down the exact same river valley that destroyed a Chinese-built power station just 13 months earlier. This isn't the first time the mountains have done this. It's the second. Nepal sits on 83,000 megawatts of hydroelectric power, one of the largest untapped energy reserves on the planet. India and China have poured billions of dollars into capturing a piece of it, fighting each other for construction contracts, canceling deals, awarding them to rivals. But every time a dam gets built here, the same mountains that hold the power seem to determine to take it back. So who actually pays when a billion-dollar investment gets erased overnight? The answer says more about power in Asia than any war ever could. What is far less certain is which country holds the advantage once reconstruction begins. China could use the moment to reassert itself, offering rapid financing and construction capacity to rebuild damaged infrastructure before India moves, potentially strengthening its position in a sector it has struggled to dominate under India's export restrictions. Alternatively, India, with its far larger existing footprint in the Nepal's export market and its deeper financial relationship with the Nepal Electricity Authority, may simply absorb the disruption as a temporary setback, confident that its structural advantage in the domestic power purchase market remains intact regardless of who rebuilds which specific plant. There is also a scenario worth taking seriously precisely because it is less dramatic than the others. Nothing fundamentally changes. Under this outcome, both countries continue investing roughly as before. Damaged projects get repaired using existing insurance and financing mechanisms, and the underlying competition for Nepal's rivers resumes largely unchanged within a year or two, the same pattern observed after the 2025 flood. Available data does not yet indicate which of these scenarios is more likely. What is confirmed is only this: the underlying financial incentive for both India and China to control a share of Nepal's 83,000 megawatts has not disappeared, and neither has the risk sitting directly in its path. One risk that deserves specific attention going forward involves climate trends across the Himalayas. Scientists studying glacial retreat in this region have documented an increase in the frequency of glacial lake outburst floods and sudden ice-related water surges over the past 2 decades. If that broader pattern continues, the kind of disaster that struck Rasuwa in 2025 and again in 2026 may not remain a rare once-in-a-generation event. It could become a recurring cost of doing business in one of the most geopolitically contested and physically unstable river valleys on the planet. For a country like Nepal, that possibility raises the stakes of every future financing decision. If floods of this scale become more frequent rather than less, the cost of insurance, the terms of new loans, and the willingness of either neighbor to keep investing at the same pace could all shift in ways that are difficult to predict today. What seems clear, based on the pattern of the last 2 major floods in this exact corridor, is that the next chapter of this story will be written as much in boardrooms in Beijing and New Delhi as it will be in the mountains themselves.
If you have stayed with us this far, subscribe to Capital and Consequence and join us for more long-form documentaries about money, power, and the consequences behind the headlines. With that said, let's look at what comes next, because the story of Nepal's rivers does not end with a single flood, no matter how severe. It raises a harder question about what happens going forward, and here, the honest answer involves more uncertainty than certainty.
One likely scenario, based on how both India and China have responded to previous disasters in this same region, is reconstruction rather than retreat. After the 2025 flood damaged the Rasuwagadi project and destroyed the Nepal-China Friendship Bridge, neither government abandoned its investment. Repairs began within months, and financing continued. Analysts who track the region generally expect a similar pattern this time. Damaged plants will most likely be rebuilt, not written off, because the strategic value of maintaining a foothold in Nepal's energy sector for both India and China tends to outweigh the cost of any single disaster. A second scenario, one increasingly discussed among regional infrastructure specialists, involves stricter engineering standards for any new hydropower construction in flood-prone valleys like Rasuwa. Available evidence suggests that two significant floods along the same river corridor within just 13 months will likely force both Nepali regulators and foreign lenders to reconsider what counts as an acceptable flood risk assessment before approving future financing. This could mean higher construction costs, longer approval timelines, and potentially fewer new projects being greenlit in the most exposed sections of the border region, at least in the near term. A third, more structural scenario centers on transmission diversification. Under this scenario, Nepal, India, and China could accelerate investment in alternative transmission routes that do not depend entirely on the narrow, geologically unstable corridors along the Nepal-Tibet border, spreading both the physical risk and the geopolitical leverage across a wider set of infrastructure. This remains a projection rather than a confirmed plan, but it is one many energy analysts consider increasingly plausible, given the recurring damage in this specific stretch of the Himalayas. Put these three forms of leverage together: energy dependence, infrastructure access, and diplomatic standing, and Nepal's rivers stop looking like a purely economic story and start looking like one of the clearest examples anywhere in the world of how capital converts directly into geopolitical influence without a single soldier or weapon involved. This is not a hypothetical dynamic. It plays out in concrete, observable decisions. When Nepal's government has to choose between two competing bids for a major dam, the decision is rarely made on engineering merit alone. Diplomatic relationships, the terms of concessional loans, and calculations about which neighbor to favor on a given year all factor into a choice that, on paper, looks like a simple construction contract. Nepal, for its part, has tried to play both sides carefully, accepting investment from each country in different river basins, avoiding a level of dependence on either India or China that would compromise its own sovereignty. That balancing act has largely worked, but it also means every new hydropower announcement in Nepal carries a weight far beyond its immediate tragedy on the ground. It did not just damage concrete and turbines. It disrupted a live, ongoing contest for regional influence, damaging Chinese-linked and Indian-linked infrastructure alike, along a border corridor both countries consider strategically important. Every plant that goes offline delays the exact leverage, energy dependence, infrastructure access, diplomatic standing that both India and China have spent over a decade and billions of dollars trying to build. The mountains, in this sense, do not take sides. They do not care whether the concrete they wash away was financed in Beijing or New Delhi. But by destroying infrastructure indiscriminately, they force both governments to confront an uncomfortable truth: that all the capital, all the leverage, and all the diplomatic maneuvering in the world cannot fully control a river that answers to neither of them.
Every dam, every canceled license, every export rule discussed so far eventually points towards the same underlying question:
how does controlling a river in the Himalayas translate into actual power on the world stage? The answer lies in three forms of leverage that money alone cannot buy, but that money makes possible. The first is energy dependence. As Nepal's exports to India have grown, so has India's reliance on that electricity to meet demand in its northern and eastern states, regions that are otherwise expensive and politically difficult to serve with new domestic generation. Every additional megawatt Nepal sends across the border deepens a relationship where India needs Nepal's rivers just as much as Nepal needs India's market. That interdependence gives India a direct incentive to keep influencing which projects get built and by whom, because the electricity flowing into its own grid ultimately depends on decisions made in Kathmandu. Dependence, once established, becomes difficult and expensive to reverse. The second form of leverage is infrastructure access. In geopolitics, physical infrastructure inside a smaller neighboring country is rarely just about commerce. A Chinese-financed transmission corridor or a Chinese-built substation sitting close to the Nepal-Tibet border represents a permanent physical foothold in a strategically sensitive location, regardless of how profitable that specific asset turns out to be. The same logic explains why India has pushed so aggressively to keep Chinese-financed projects out of its own grid. Allowing Chinese-controlled infrastructure to feed directly into India's power system would mean accepting a degree of dependence on Beijing that New Delhi has explicitly decided it will not tolerate. This is not really a debate about kilowatts. It is a debate about which country's infrastructure sits closest to whose territory. The third form of leverage is diplomatic standing inside Nepal itself. Every major hydropower deal comes with negotiations, ministerial visits, financing packages, and public announcements that shape how Nepal's own government and public perceive its two giant neighbors. A large, high-profile hydropower agreement lets either India or China present itself as Nepal's essential economic partner, reinforcing political relationships that extend well beyond energy into trade policy, security cooperation, and diplomatic alignment on issues far removed from any single river.
Foreign investors and construction firms, meanwhile, do not escape the flood untouched, but their exposure is far more cushioned. Most major hydropower projects in Nepal carry insurance coverage negotiated as part of the original financing package, often required by the international lenders backing the loan in the first place. When physical damage occurs, insurance can cover a meaningful share of rebuilding costs, softening the blow for the equity holders who would otherwise absorb the full loss. Construction firms that have already been paid for the original build, separate from whether the plant later succeeds, have effectively secured their return regardless of what happens afterward. And developers with large, diversified portfolios spanning multiple countries can treat a single damaged project in Nepal as a manageable setback rather than an existential threat, the same way an investor might treat one underperforming stock inside a much larger portfolio. This is the core asymmetry running underneath the entire relationship. A foreign Chinese state-linked construction conglomerate with hydropower projects on 4 continents, a damaged plant in Rasua is a line item, a temporary dip in one subsidiary's output, absorbed within a portfolio worth many times more than the project itself. For Nepal, that same plant may represent a meaningful share of the country's entire generating capacity in that district, a debt obligation the national treasury still has to service, and months of lost export revenue at a time when the country can least afford it. The flood does not care about the size of either balance sheet, but the balance sheets determine afterward who actually feels the loss. If the profits from Nepal's hydropower boom flow mostly outward, the losses when something goes wrong tend to flow the opposite direction, downward onto the people and institutions with the least ability to absorb them.
Start with the most immediate cost: human life. Families in villages like Timure and Shabrubesi, communities that sit directly along the rivers these dams depend on, have almost no financial stake in the profits these projects generate, but carry the full physical risk of living beside them. When a flood surges down the valley, it is their homes, their bridges, and often their lives that disappear first, long before the financial consequences reach a boardroom in Beijing or New Delhi. This is not a new risk that arrived with hydropower, but large-scale dam construction has concentrated population and infrastructure closer to riverbanks that were once left undeveloped precisely because they were considered too dangerous. Then there is Nepal's government itself, which absorbs costs in ways that rarely make headlines. When a hydropower facility is damaged, the country still owes debt service on loans tied to that project, regardless of whether the plant is generating any revenue. Emergency response, search and rescue operations, military deployment, and reconstruction of roads and bridges connecting affected districts all come out of a national budget that was already stretched thin. Nepal's electricity authority faces its own version of this problem. As the sole legal buyer of most domestic power, it must find replacement electricity, often more expensive imported power from India, to cover the gap left by damaged plants. That cost typically gets passed along through higher electricity prices or absorbed as a loss on the utility's own balance sheet, a cost ultimately paid by ordinary Nepali households and businesses who had no role in deciding where or how these dams were built. China's advantage looks different, but it is no less real. Even when a Chinese-financed project cannot export to India, Beijing still gains something valuable: a foothold in Nepal's domestic energy market, influence inside Nepal's investment board and energy ministry, and a physical, permanent presence along a border it shares with both Nepal and, indirectly, India. In geopolitics, that kind of long-term positioning can be worth more than the return on any single dam. China has applied this same playbook across Central Asia, Africa, and South America. Build infrastructure that may be only moderately profitable on paper in exchange for decades of political access and goodwill. Even Nepal's government captures real value, though far less than either foreign power. Every operating dam generates royalty payments, licensing fees, and a share of electricity that the Nepal Electricity Authority can allocate domestically. Local employment during construction, followed by long-term maintenance jobs, provides income in some of the country's poorest districts. And every megawatt exported to India earns foreign currency that Nepal, a country with a chronic trade deficit, badly needs. But here is the imbalance that defines the entire sector. The foreign firms that finance and build these dams typically see their capital returned plus profit within 15 to 25 years, and then continue collecting revenue for decades afterward under extended operating agreements. Nepal, meanwhile, often does not gain full ownership or control of a project until that concession period ends, sometimes 30 years or more after construction begins. For most of a dam's productive life, the majority of its profit flows outward, to Mumbai, to Beijing, to shareholders and state banks thousands of kilometers from the river itself. This is not unusual for developing world infrastructure. It is, in fact, the standard model used across the industry. But it means that when a flood destroys a hydropower plant only a few years into its operating life, the financial damage rarely falls evenly either. Some parties have already recovered enough of their investment to absorb the loss. Others have not.
Foreign investors and construction firms, meanwhile, do not escape the flood untouched, but their exposure is far more cushioned.
Most major hydropower projects in Nepal carry insurance coverage negotiated as part of the original financing package, often required by the international lenders backing the loan in the first place. When physical damage occurs, insurance can cover a meaningful share of rebuilding costs, softening the blow for the equity holders who would otherwise absorb the full loss. Construction firms that have already been paid for the original build, separate from whether the plant later succeeds, have effectively secured their return regardless of what happens afterward. And developers with large, diversified portfolios spanning multiple countries can treat a single damaged project in Nepal as a manageable setback rather than an existential threat, the same way an investor might treat one underperforming stock inside a much larger portfolio. This is the core asymmetry running underneath the entire relationship. A foreign construction giant that loses one dam in Nepal can absorb that loss across dozens of other projects worldwide. Nepal cannot diversify away from its own rivers. There is no alternative Nepal for Nepal to spread its risk into. Every flood that damages hydropower infrastructure here lands on the same economy, the same government budget, and often, quite literally, the same families again and again. There is also a slower, less visible cost, reputational and financial risk that makes future investment more expensive. Every major flood that damages hydropower infrastructure raises the perceived risk profile of investing in Nepal at all, which can push up the interest rates lenders demand on the next project, or make certain international insurers more reluctant to underwrite new construction in flood-prone valleys altogether. In other words, disasters like this one do not just destroy existing infrastructure, they quietly raise the cost of building the next dam, a cost that, once again, Nepal will be the one paying. Compare this to how the same disaster reads on two different balance sheets. For a Chinese state-linked construction conglomerate with hydropower projects on 4 continents, a damaged plant in Rasua is a line item, a temporary dip in one subsidiary's output, absorbed within a portfolio worth many times more than the project itself. For Nepal, that same plant may represent a meaningful share of the country's entire generating capacity in that district, a debt obligation the national treasury still has to service, and months of lost export revenue at a time when the country can least afford it. The flood does not care about the size of either balance sheet, but the balance sheets determine afterward who actually feels the loss.
This is where India's export rule turns from policy into pure financial mechanism. Because Indian regulators will not approve cross-border power sales from any project with significant Chinese ownership, a dam built by a Chinese firm is effectively locked out of the one market that makes the investment truly profitable. It can still sell power domestically inside Nepal, but at a fraction of the return. In practical terms, the nationality of the construction contract can be worth more to a project's long-term value than the size of the river it sits on. This mechanism explains a pattern that otherwise looks strange from the outside. Major dam licenses in Nepal changing hands, moving from Chinese developers to Indian ones, not because of engineering failures or missed deadlines, but because of market access. When a Chinese-linked project loses its path to the Indian grid, its financial logic collapses, and Nepali authorities, eager to see the dam actually get built and start generating revenue and tax income, have repeatedly reassigned those licenses to Indian firms who can clear the export hurdle. Projects worth well over $2 billion have moved this way in the past decade alone. China, for its part, has not simply walked away. Beijing has continued pledging fresh billions toward Nepal's hydropower sector, betting that even power sold only within Nepal or eventually routed through new transmission corridors that bypass India's restrictions entirely will justify the investment over a long enough timeline. Chinese firms have also shifted strategy toward projects that serve Nepal's domestic grid directly,
or that support industries like cement and steel, where Chinese capital already has a foothold. The result is a hydropower sector where the physical engineering, the concrete, the turbines, the transmission towers, is almost secondary to a financial and political calculation happening in Kathmandu, New Delhi, and Beijing simultaneously. Every dam under construction in Nepal right now carries an invisible ledger alongside its construction budget. Who financed it? Who will be allowed to buy its power? And which of Nepal's two giant neighbors will ultimately benefit from that specific river's electricity? That ledger and the billions of dollars riding on it assumes one thing above all else, that the physical structure survives long enough to ever generate a return. To understand how money actually moves through a Nepali hydropower project, you need to follow it from the moment a river becomes a business plan. It starts with a concession. The Nepali government, through its investment board, grants a license to build a dam on a specific stretch of river, usually to a joint venture between a foreign construction firm and a local partner. That license is the single most valuable document in this entire industry, because without it, none of the capital that follows can move at all. Once the license is secured, the real money arrives in 3 layers. The first is equity, cash put in directly by the developer, whether that developer is a Chinese state-linked construction giant or an Indian power company. The second is debt, loans from development banks, export-import banks, or the developer's own government, often at favorable rates because Beijing and New Delhi both treat hydropower financing as a tool of regional influence, not just a commercial loan. The third layer, and the one that determines whether the first two ever pay off, is the power purchase agreement. This is the contract that decides everything. It is signed between the dam's owner and whichever national utility agrees to buy the electricity. Almost always, Nepal's own state utility, the Nepal Electricity Authority, acting as the sole legal buyer inside the country. But the real prize was never the domestic market. Nepal's own demand is small compared to what these dams can produce. The real money is in exporting the surplus, and that is where the story splits in two. If a dam sells its power only inside Nepal, the returns are modest and slow. If it can export across the border into India, the price per unit rises, the market is enormously larger, and the project starts to look like a genuinely attractive investment. That single difference, domestic sale versus cross-border export, is often the line between a dam that struggles for 2 decades and one that becomes profitable within a handful of years. Which is exactly why the question of who gets permission to export and to whom is never just an engineering matter. It is the single lever that determines whether billions of dollars in capital ever earns a return at all. What changed was not Nepal's engineering capacity. What changed was that its two neighbors started paying attention. Starting in the early 2010s, both India and China began treating Nepal's hydropower sector not just as a business opportunity, but as a piece of regional strategy. Chinese state-linked construction firms moved in first in several major river basins, winning contracts for some of the largest proposed projects in the country, including massive storage dams capable of generating well over 1,000 megawatts each. Indian firms moved into other basins, often closer to the Indian border, where the electricity produced could almost directly flow into the Indian grid. On the surface, this looked like healthy competition, the kind of foreign investment race that should benefit a developing country. Two of the world's largest economies, both eager to fund infrastructure Nepal could never afford to build alone. But underneath, the dynamic was never just about dams. It was about which power grid the dam would ultimately feed, and which government would end up controlling the flow of electricity along a river that both India and China consider strategically sensitive. By the middle of the 2010s, that tension had turned into open policy. India, which remains by far Nepal's largest single electricity buyer, formalized a rule that would define the sector for the next decade. Any Nepali hydropower project with meaningful Chinese ownership or financing would not be allowed to sell its power into the Indian grid, not because the electricity itself was different, because of who built it. That single policy reshaped the entire investment map of Nepal. Projects that had already been awarded to Chinese firms suddenly faced a serious problem. Without access to the Indian market, the largest and closest buyer for Nepali electricity, some of those projects became far less financially viable. Over the following years, several major dam licenses that had once belonged to Chinese firms were canceled, stalled, or quietly reassigned to Indian developers instead, sometimes for deals worth well over $2 billion. Nepal's own energy ministry became less an engineering authority and more a chessboard, where the biggest question about any new dam was never just how much power it would generate, but which grid it would ultimately be allowed to join. By 2026, China had responded with its own renewed push, pledging billions in fresh investment to stay competitive in a sector it had never fully abandoned. Nepal, caught in the middle, kept approving projects from both sides, hoping to capture investment from both neighbors without fully belonging to either. None of that, however, explains what happened on August 26, 2026, because the money, the politics, and the competing grids all assume the dams will still be standing when the water arrives. And in this particular stretch of the Himalayas, that assumption has already failed once before. When a hydropower project in Nepal actually clears every hurdle, the license, the financing, the export approval, and starts generating electricity, the profits do not flow evenly. Some players capture enormous value, others barely break even. And understanding who ends up on which side reveals a lot about how modern infrastructure power actually works. The clearest winners are the construction and engineering firms that win the original contract, particularly the large state-linked companies from India and China that specialize in this kind of build. These firms typically operate on a model where they are paid for construction regardless of how the plant performs afterward, then often retain an equity stake or a long-term operations contract on top of that. In effect, they get paid to build the dam, and then they get paid again for decades if it succeeds. Chinese firms following this model have built experience and reputation across multiple continents, using Nepal as one node in a much larger portfolio of hydropower projects, stretching from Pakistan to East Africa. Second are the utility-scale developers themselves, the Indian and Nepali joint ventures that hold the actual operating license. Once a dam clears the 10 to 15-year payback period common in hydropower, and once it has export access to India's much larger and higher-paying market, the economics become extraordinarily favorable. Hydropower plants, unlike gas or coal facilities, have almost no fuel cost. Once built, the primary ongoing expense is maintenance and debt service. A dam that survives its first decade and secures reliable export contracts can generate profit margins that few other infrastructure investments can match. Then there is India itself, which benefits in a way that goes beyond any single project's balance sheet. Every megawatt Nepal exports helps India meet growing electricity demand in its northern states without having to build that generating capacity on Indian soil, using Indian land, or facing Indian environmental opposition. That arrangement, repeated across dozens of projects, has made India Nepal's single largest export destination for hydropower and given New Delhi enormous leverage over which projects get built at all. So who actually pays when a billion-dollar dam gets destroyed in the Himalayas? By now, the answer should be clear. and it is not the answer most people would expect from a headline about a natural disaster. The money that built these dams came from Beijing and New Delhi, flowing through state banks, construction conglomerates, and power companies, competing for a piece of Nepal's 83,000 megawatts of untapped potential. The mechanism behind that competition was never really about engineering, it was about access. Specifically, access to India's power grid, the single market that turns a modest hydropower project into a genuinely profitable one. That access became a political weapon, reshaping which companies got which licenses and quietly determining years in advance who would profit and who would not. The winners in this system were rarely the people living beside the rivers. They were the construction firms paid regardless of long-term performance, the developers who cleared the export threshold and locked in decades of revenue, and the two governments who each converted infrastructure spending into lasting political leverage, energy dependence, physical footholds, and diplomatic standing that outlasts any single contract. The losers were more predictable and more exposed. Nepali communities living along unstable river corridors, absorbing the physical risk of infrastructure they never fully profit from. Nepal's own government carrying debt obligations and reconstruction costs that do not disappear just because a plant stops generating revenue. And ultimately, ordinary Nepali households who pay for replacement electricity and absorb the economic aftershocks of a disaster they had no role in causing. When the flood came down the Botakoshi Valley in August 2026, it did not check whose money built what it was about to destroy. But the aftermath did what floods never do. It revealed with total clarity whose capital was protected by insurance and diversified portfolios, and whose future was tied entirely to a single river that neither Beijing nor New Delhi actually controls. There's a broader pattern here, too, one that reaches well beyond Nepal. Around the world, from Central Asia to East Africa to South America, the same basic structure repeats itself. A resource-rich country becomes the stage where larger powers compete for infrastructure access, and the local population absorbs a disproportionate share of the physical risk, while a disproportionate share of the long-term profit flows outward. Nepal's rivers are simply one of the clearest, most visible examples of that pattern, because the competition here is unusually direct. Two neighboring superpowers, one small country, and a resource that cannot be moved, hidden, or replicated elsewhere. What makes this story different from a typical geopolitical rivalry is that no army was ever involved, no sanctions were imposed, no treaty was violated. Every decision described in this documentary, every canceled license, every export restriction, every reassigned contract, was made through entirely legal, financial, and regulatory channels. That is, in many ways, the most important insight of all. Global power today is decided as often through power purchase agreements and construction financing as it is through military strength. And Nepal's rivers show exactly how quietly that kind of influence can be built, one dam, one contract, $1 billion at a time.
That is the real lesson sitting underneath this story. Nepal was never just a small country caught between two giants. It was the terrain where two of the world's largest economies chose to compete, using rivers instead of tariffs, construction contracts instead of warships. And like every contest for territory throughout history, the ground itself eventually reminds everyone involved that it was never fully anyone's to control. 83,000 megawatts still sit in those mountains, mostly untouched. Billions of dollars are still moving toward capturing a share of it. And somewhere in a valley between Kathmandu, New Delhi, and Beijing, the next dam is already being planned, financed by the same calculations, exposed to the same risks, waiting to find out whether this time the mountain lets it stand.
If this documentary helped you see a familiar headline differently, consider subscribing to Capital and Consequence for more long-form investigations into the money behind global power. A like helps more than you might think, and if you know someone who follows money, power, or global affairs closely, this is exactly the kind of story worth sending their way. Let us know in the comments what you think happens next in Nepal's hydropower race, or which country, region, or industry you would like to see us investigate in a future documentary. For viewers who want the full research dossier behind this documentary, the Capital and Consequence dossier is available in the description. Until the next documentary,
Capital and Consequence. Follow the money. Understand the consequences.